All right. So, we're going to dive into something today that you said has been on your mind lately.
Okay.
And that is beta. And I got to say, I hear this word all the time. And it's one of those things, in the financial world where sometimes it's like,
yeah,
are we speaking in code?
Right.
What is this?
Yes.
So luckily you came with some notes and excerpts, even some stuff from veers.pdf.
Right.
We're going to crack this code together.
Yeah.
So when we talk about beta, we're talking about how sensitive an asset is to the market's ups and downs.
That's right. And think about it like this, the market's this giant wave pool.
Oh, okay.
And beta tells you how much your little investment boat is going to bob around.
Okay, I like that.
Yeah.
So it's not just about whether an investment goes up or down.
Right.
It's about how dramatically it reacts to those market waves.
Yeah. Beta is that coefficient, that number that tells you just how much an asset's price is likely to move compared to a benchmark like the S&P 500.
Okay. All right. So walk me through this.
Sure.
What kind of beta scores are we talking about?
Okay.
And what do they really tell us?
Well, beta of 1 means an asset moves pretty much in sync with the market.
Okay.
So say the market goes up 5%, an asset with a beta of 1 would likely go up 5% too.
That makes sense.
Mm-hmm.
But what if we're talking about something a little riskier?
Then we're looking at a beta greater than 1.
Okay.
These assets are the thrill seekers of the market, amplifying those market movements.
Okay.
So if the market jumps up 5%, an asset with the beta of 1.5 might surge up 7.5%.
Whoa. Okay, that's a big difference.
Yeah.
But of course, what goes up
can also come down hard.
Right.
That's the risk with high beta.
Yeah.
If the market takes a dip, those high beta assets can plummet even faster.
Yeah.
Think of something like Tesla with beta over 1.5.
Right.
It can be a wild ride.
Okay.
Yeah.
So that's the high stakes game. What about more cautious investments?
Those tend to have betas less than 1. They're still in the pool, but they're riding those waves a bit more smoothly.
Okay.
A good example is Coca-Cola with a beta around 0.6 or 0.7. Not as flashy, but it tends to hold its own.
So like a nice steady sailboat, not a speedboat?
Exactly. And then there's this fascinating category.
Okay.
Negative beta.
So this is where I get a little lost.
Okay.
Negative beta.
Yeah.
Does that mean it moves in the opposite direction?
You got it.
Of the market?
If the market dives down, an asset with a negative beta could actually go up.
Really?
These are often your safe havens. Things like gold that people flock to when the market gets stormy.
Oh, that's wild.
Yeah.
Okay.
It's pretty cool.
So knowing this beta score can really help you figure out how much risk you're comfortable with. But how on earth do they calculate this thing?
Yeah.
I've seen some formulas in these notes.
Yeah.
And they're a little intimidating.
Don't worry, we won't get bogged down in the heavy math. The key is understanding the 2 main ingredients, covariance and variance.
Okay, break those down for me.
Okay. Imagine you've got 2 dancers. The asset and the market.
Okay.
Covariance measures how well they dance together.
Are
their movements in sync or are they all over the place?
So are they a well-coordinated pair?
Yes.
Or are they stepping on each other's toes?
Exactly. And then there's variance.
Okay.
Which measures how much the dance floor itself is shaking.
Oh.
If it's a wild party, there's going to be a lot of variance.
Okay, so to figure out beta, you're looking at how well an asset dances with the market and how much the dance floor is moving overall.
That's the gist of it.
Okay.
Of course, there's some math involved, but that's the basic idea.
Now, I noticed in your notes that the time period you look at can really change the beta calculation.
Yes.
Why is that?
It's like judging a dance competition based on one song versus the whole night.
Okay.
You're going to get a different impression in finance. We usually look at beta over a longer time frame, like 5 years. This gives us a more stable picture of how an asset tends to behave.
So you're looking for those long-term trends rather than just a quick snapshot.
Right. But we can also look at shorter time frames, like 3 years or even 1 year. This can be useful if you're trying to understand how an asset might react to more recent events.
So it's like looking at the dance moves over a whole season.
Exactly.
Not just a single performance.
And speaking of judging fairly, something else that stood out to me in your notes was how important it is to compare an asset to the right benchmark.
You're saying it's like comparing apples to apples.
That's excellent.
Not apples to oranges.
If you're looking at a company that does most of its business overseas, comparing it to the S&P 500 might not give you an accurate beta.
So it's like judging a waltz based on the rules of salsa, you need the right context.
Right. Take Airbus, for example. It's a European company, but most of its sales are global. Comparing it to a global aerospace index might make more sense than just looking at a European market index.
Okay, so finding the right benchmark is crucial.
Absolutely.
For getting an accurate read on beta.
Sometimes you need a global index, sometimes an industry-specific one, and sometimes even a combination.
Wow.
It's all about finding the best point of comparison.
This is starting to make a lot more sense now.
Good.
We're seeing how this beta score is calculated, how to interpret those different values, and how to make sure we're comparing things fairly. But I'm a visual learner.
Okay.
Is there a way to actually see beta in action?
There is, and it might just bring our dance analogy full circle.
Okay, now you've got me intrigued. Let's hear it.
All right.
All right, so we're back, and you're going to tell me now how to visualize beta.
Okay.
Using scatter plots.
They're a great way to actually see how beta works. Picture a graph like the ones you'd see in math class. On one axis, you've got the market's returns. And on the other axis, you've got the assets returns.
Right.
Each point on the graph represents a specific moment in time.
Okay.
Showing how the asset moved compared to the market.
So we're plotting those dance moves, but instead of steps, it's percentages.
And here's where it gets really cool.
Okay.
You can draw a line that best fits all those points called the regression line. And guess what?
What?
The slope of that line represents the beta.
So if the line is shooting straight up, that means
High beta?
High beta.
Right. That steep slope tells you the asset is super sensitive to market swings, just like those high beta stocks we talked about earlier.
And a more gradual slope would mean
a lower beta.
A lower beta.
Precisely, a lower beta asset is going to have a flatter line showing that its returns are less influenced by those market waves.
Okay, that makes sense. But what about those times when an asset doesn't follow the line perfectly?
Yeah.
I'm imagining some points scattered above and below it.
Those are the outliers.
And
they can be super interesting. So they show us when an asset has performed better or worse than its beta predicted.
So it's like those moments in a dance when someone improvises.
Exactly.
Or goes off script.
Those points above the line might mean the company had some good news or made a smart move that boosted its stock price beyond what the market was doing.
And those below the line might mean something went wrong.
Right.
Even if the market was doing okay.
It could be a bad earnings report, a product recall, or any number of things that are specific to that company.
So these scatter plots are like a window into how an asset actually behaves in the real world.
They are.
Beyond just that single beta number.
And they remind us that beta is a guide, but it's not a crystal ball. There are always other factors at play.
Now, I also saw something in my notes about comparing an index to another index using beta.
That's a great point. We've been talking about an asset's beta relative to the S&P 500, but we could also look at how, say, the S&P 500 itself behaves compared to a global index like the MSCI World.
So it's like judging one dance troupe against another.
Yes, and that beta would tell us how sensitive the S&P 500 is to the movements of the global market. It gives us a broader perspective on its performance.
This is fascinating stuff, but I have to admit, I'm still wrapping my head around why we keep talking about that regression line.
Okay.
What makes it so special?
It's not just any random line. It's statistically calculated to be the line that best fits all those data points. It represents the average relationship between the asset and the market.
So it's like finding the trend line that smooths out all those individual dance moves.
And the slope of that trend line, that's our beta, it tells us on average how much the asset's return changes for every 1% change in the market's return.
Now, we've been focusing so much on the market's influence.
Right.
But there's another type of risk you mentioned earlier, idiosyncratic risk.
Right. That's the risk that's specific to a particular company or asset. It's not tied to the overall market.
So it's like those individual missteps a dancer might make.
Exactly.
Even if the whole dance floor is stable.
Think of things like management changes, product failures, scandals, or even natural disasters affecting a company's operations. Those are all examples of idiosyncratic risk.
And these risks can't be predicted by looking at beta.
Right. Beta only tells us about the market risk, the systematic risk. Idiosyncratic risk is unique to each individual asset.
So how do we even begin to manage idiosyncratic risk?
Well, there's a powerful tool for that, and I think you can guess what it is: diversification.
Our old friend.
Right.
So spreading our investments across different asset sectors and even geographies can help to cushion the blow.
Exactly.
If one of those companies hits a rough patch.
By diversifying, you're essentially reducing the impact of any single company's idiosyncratic risk on your overall portfolio.
No.
It's like having a backup dancer ready to step in if someone stumbles.
I like that this is all starting to click into place now. Good. Beta helps us understand the market's influence, and diversification helps us manage those company-specific risks.
You got it. And while both are important, it's crucial to remember that they are distinct concepts. Beta measures an asset's sensitivity to market-wide movements, while idiosyncratic risk is those individual, unpredictable events.
It's like knowing the dance floor might shake a bit.
Yeah.
But also being aware that any dancer can trip at any time.
A great analogy, and knowing both can help you build a more balanced and resilient investment strategy.
This has been an incredible deep dive. So far, we've gone from feeling like beta was a secret code to actually seeing it in action with those scatter plots.
Yeah.
We've explored how to choose the right benchmarks, and we've even tackled those unique risks that beta can't predict.
We've covered a lot of ground, but there's still one more piece of the puzzle to explore.
Okay.
In the final part of our deep dive, we'll bring all this together and talk about how you can use this knowledge of beta to make smarter investment decisions.
Don't go anywhere. We'll be right back. Okay, welcome back. So I feel like we've cracked the code on beta. Like we really...
Yeah.
We've explored what it is. We've explored how it's calculated, how to even visualize it.
Right.
But the million-dollar question, I think, is how do we actually use this to make smarter investment decisions?
That's the million-dollar question, literally.
Right.
And the answer isn't one size fits all.
Okay.
It depends on your personal risk tolerance and what you're hoping to achieve with your investments.
Okay, so walk me through this.
Sure.
Let's say I'm someone who's pretty comfortable with risk.
Okay.
I'm looking for those big potential gains.
Okay.
What role does beta play in my strategy?
Well, you might be drawn to those high beta stocks.
Okay.
The ones that tend to amplify the market's movements. You're essentially hoping to ride those big waves to even bigger returns.
But of course that comes with the understanding that I could also experience some pretty steep drops.
Exactly. High beta investments are like those exciting roller coasters.
Okay.
Thrilling ride, but definitely not for the faint of heart.
All right. So what about someone on the other end of the spectrum?
Yeah.
Someone who's a little more risk averse.
Okay.
What does their beta strategy look like?
They might prefer those low beta stocks, the ones that offer a smoother ride. Even if it means potentially missing out on some of those dramatic gains, think of it like a scenic train journey. You might not get there as fast, but you can enjoy the view along the way.
So it's all about finding that balance between risk and reward.
Absolutely.
And beta helps us gauge that.
But remember, beta is just one piece of the puzzle. We also need to consider idiosyncratic risk, those company-specific factors that can throw a wrench in even the best-laid plans.
Right, those unexpected stumbles and missteps that even the most talented dancer can experience.
Exactly, and that's where diversification comes into play.
Right.
By spreading your investments across different asset sectors and even geographies, you're essentially creating a safety net.
So it's like having a whole dance troupe.
Exactly.
Instead of just one soloist.
If one person falters, the others can keep the performance going.
And that's where beta can actually be helpful.
Yes.
In building that diversified portfolio.
Right.
You can look at the betas of your different holdings.
Exactly.
To make sure you're not overly concentrated.
Right.
In any one area.
You might want to balance some high beta holdings with some lower beta ones to create a smoother overall ride.
So you've got your speedboat over here.
Yeah.
You got your sailboat over here.
Exactly. It's all about managing that overall risk level and making sure it aligns with your personal comfort zone.
Now, I have a question about something we discussed earlier, and that was the capital asset pricing model.
Okay.
Or KAPM.
Yeah.
How does beta fit into that?
KAPM is a model that uses beta to estimate the expected return of an investment.
Okay.
It's based on the idea that investors should be compensated for taking on more risk. So a higher beta investment is expected to have a higher potential return, but also a higher potential for loss.
So beta helps us understand not just the risk, but also the potential reward that comes of an investment.
Yes, and CAPM gives us a framework for quantifying that relationship. Of course, it's just a model and it has its limitations, but it can be a useful tool for evaluating different investment opportunities.
Wow, this has been such an eye-opening deep dive. I feel like I've gone from being intimidated by beta to actually understanding how it works and how I can use it to make more informed decisions.
I'm glad to hear that. Remember, beta is a powerful tool, but it's just one tool in your investor toolkit.
Right.
Always do your research, consider your own risk tolerance, and don't be afraid to seek advice from a financial professional if you need it.
Great advice. So we've learned so much about beta today. What it is, how to interpret those scores, how to visualize it, and most importantly, how to use it to make smarter investment decisions.
I hope this deep dive has empowered you to navigate the market with more confidence and clarity.
I know, I feel more confident. Thanks for joining us on this journey into the world of beta. And until next time, happy investing, everyone.